Every year, millions of people do exactly what they were told. They open accounts, make deposits, apply for cards, sign mortgage documents, and call it financial responsibility. They follow the steps. They trust the institutions. And the institutions quietly count on that. Not because the system is broken, but because it is working precisely as intended. There is a gap between what banking products are marketed to do and what they are structurally designed to do. Most people never see it, not because it is hidden, but because no one ever pointed at it directly. What you are about to hear isn't a theory. It is the mechanics of a system you are already inside. You have a bank account. You were told to save money from the time you were old enough to understand what money was. You were taught that responsible people deposit their earnings, let interest accumulate, and trust the institution that holds their financial life together. And so you did. Most people do. The system felt stable. The logic felt sound. You followed the rules. Here is what nobody mentioned when they handed you those rules. They were written by the people who profit when you follow them. That sentence is worth sitting with for a moment, not because it should make you angry, but because understanding it structurally and clearly changes how you see every financial decision you've made and everyone you're about to make. Most people interact with banking products every single day. Savings accounts, credit cards, mortgages, overdraft facilities, and understand almost none of the actual mechanics operating beneath the surface. This isn't a personal failure. Financial literacy is conspicuously absent from most school curricula in the United States, the United Kingdom, Canada, and Australia. That absence is not an oversight. It is an environment, and you have been operating inside it. This video exists to reconstruct the rules of the game, clearly, calmly, without drama, so that you can finally play it with your eyes open. And by the time we reach the 9th secret, you will understand exactly why the person at your bank's customer service desk always seems so genuinely pleased to see you. The first secret is one that most people sense but never fully examine. Your savings account is not growing your money. It is slowing how quickly your money disappears. The advertised interest rate on a standard savings account in most Western markets sits somewhere between 0.5% and 2%, depending on the institution and the rate environment. Inflation, the annual erosion of purchasing power, has historically run at around 3% and has exceeded that significantly in recent years. The gap between those two numbers is not incidental. It is the structural reality of what a savings account actually delivers. If your money earns 1% while prices rise by 3%, your purchasing power shrinks by 2% per year. On $10,000, that is a $200 silent loss every single year, while your balance technically increases. The bank benefits from your belief that your savings are working. A customer who feels financially responsible doesn't ask difficult questions. Doing nothing with your money is not a neutral act. It is a slow, compounding drain disguised as security. The second secret sits one layer deeper. Banks do not simply hold deposits and lend from a fixed pool of existing money. They create money, legally, every day. This is called fractional reserve banking, and it operates as follows. When you deposit $1,000, the bank is only required to hold a fraction of that, historically around 10%, as a reserve. The remaining $900 is lent to someone else. That borrower now has $900 in their account. Your original $1,000 still shows in your account. There are now, in effect, $1,900 in circulation from a single $1,000 deposit. Multiply this across millions of transactions daily, and you begin to understand that the money supply is not a fixed quantity managed by a central authority. It is an expanding construct, partially manufactured by commercial banks every time a loan is issued. The bank holds your money and lends it simultaneously. That is not a contradiction in their system. It is the system. The third secret is embedded in something most people carry in their wallet:
Credit cards are not financial tools designed for your convenience. They are revenue products engineered for behavioral dependency. The minimum payment structure is the mechanism worth understanding here. When a bank allows you to carry a balance forward by paying only a small fraction of what you owe each month, it is not offering you flexibility. It is extending the duration of your debt, and therefore the duration of their interest revenue. The rewards programs, the cash back percentages, the airline miles, these are funded, in large part, by the interest charged to the portion of cardholders who cannot pay their balance in full. You are either collecting the subsidy or providing it. The credit card as a product is designed so that the majority of users, over time, migrate into the group that provides it. Convenience is the entry point. Dependency is the destination. The fourth secret is one that tends to produce a particular kind of quiet frustration once you see it clearly. Interest rates are not uniform. They are tiered, and the tier you are placed in is determined largely by how much wealth you already possess. A person with substantial assets, high income, and an extensive credit history borrows at the lowest available rates. A person with limited assets, moderate income, and a shorter credit profile pays significantly more for access to the same capital. The gap can be substantial, sometimes a factor of 10 or more between the rate paid by a high net worth borrower and one paid on a payday loan or high-risk personal credit product. And because compounding works in both directions, cheaper debt accelerates wealth accumulation, while expensive debt slows it. The structure is the same word. The financial outcome is opposite. Understanding which kind of debt you are carrying is not a minor distinction. It is the central variable in your long-term financial trajectory. The sixth secret involves a mechanism that is entirely legal, rarely discussed in mainstream financial media, and essentially unavailable to anyone who doesn't already possess significant wealth. When high net worth individuals need liquidity, cash to spend, invest, or deploy, they frequently do not sell their assets. Selling triggers a taxable event. Instead, they borrow against those assets. A bank will lend against a portfolio of shares, a real estate holding, or business interest using the asset as collateral. The borrower receives cash. No asset was sold. No capital gains tax is triggered. The loan carries a low interest rate. The asset continues to appreciate. This structure, sometimes called a securities-backed loan or asset-backed credit facility, is not exotic. It is standard practice in private banking divisions at every major financial institution. It's simply not offered to retail customers because retail customers generally don't have the asset base to qualify. Paying taxes is mandatory, unless you own enough to never need to convert your wealth into income. The eighth secret moves the frame outward to a global scale. Estimates from academic economists and financial watchdog organizations place the volume of wealth held in low-tax or zero-tax offshore jurisdictions at somewhere between $8 and $32 trillion, depending on the methodology used. This is not primarily the domain of criminal enterprise. It is the domain of large corporations and high-net-worth individuals using entirely legal structures, subsidiary companies, licensing arrangements, intellectual property transfers, to shift declared income away from the jurisdictions where their economic activity actually occurs and towards jurisdictions that impose minimal or no taxation. The gap between where wealth is earned and where it's declared is not a loophole. It is an engineered architecture. The eighth secret is the one that most likely affects you personally, and the math behind it is almost never presented clearly at the point of sale. When you take out a 30-year mortgage on a $300,000 property at a fixed rate of around 5%, you do not pay $300,000 for that home. You pay closer to $580,000 over the life of the loan, nearly double the purchase price. The additional $280,000 is interest, and critically, the amortization schedule, the structure determining how each payment is split between principal and interest, is front-loaded. In the early years of the mortgage, the majority of each monthly payment services interest, not principal. Your equity builds slowly at first and accelerates toward the end of the loan term. This structure is not accidental. It maximizes the bank's revenue from the loan in the period when you are least likely to have paid it off.
The ninth secret is the reason the customer service representative seems so glad you walked in. Banks generate billions of dollars annually from fee structures that are, by design, difficult to monitor and aggregate. Overdraft fees, monthly maintenance charges, minimum balance penalties, foreign transaction fees, wire transfer fees, paper statement fees, inactivity fees, each one small, each one disclosed somewhere in a document you signed without reading in full, each one nearly invisible on an individual basis. In the United States alone, overdraft fees have historically generated over $30 billion per year. The behavioral design is deliberate. When a transaction would overdraw your account, many banks approve it rather than decline it, then charge a fee that can reach $35 on a $10 shortfall. That is a 350% effective interest rate on a one-day loan you didn't ask for. You agreed to every fee. You were never meant to add them up. The 10th secret is structural rather than individual. The banking system, as currently configured, does not benefit from your savings. It benefits from your debt. The evidence is visible in the spread between what banks pay on deposits and what they charge on loans, a gap that can span 20 percentage points or more. When the system sets deposit rates near zero, while credit card rates sit at 18 to 28%, it is communicating its incentives clearly. A customer who saves diligently and carries no debt is, from the bank's revenue perspective, a poor customer. A customer who carries a revolving credit card balance, services a mortgage, and maintains a modest savings account generating near zero interest is generating income across three products simultaneously. Banks market savings accounts because they need deposit capital to issue loans, but they profit most when you borrow. The system is built to reward consumption and penalize patience. This isn't cynicism, it's a business model. The 11th secret is where the earlier promise pays off. Your deposits do not sit in a vault. They are deployed into markets, into financial instruments, into investment vehicles of varying complexity and risk. In some cases, those instruments are straightforward. Government bonds, intrabank lending. In others, they are considerably more opaque, structured credit products, derivatives, leveraged positions. The 2008 financial crisis was, at its core, a demonstration of this asymmetry. The risk was held by depositors and taxpayers. The profits had already been collected by the institutions. When losses materialized on a scale that threatened systemic collapse, government intervention, funded by the public, prevented that collapse. The executives responsible, in many institutions, retained their compensation. Your deposits funded the positions. Your taxes funded the rescue. The bank's customer service representative is genuinely glad you came in today. Your money is about to do a great deal of work, none of which you will benefit from directly. The 12th secret is the one most people with moderate financial stability tend to overlook because it does not affect them directly. The financial system imposes its highest costs on its most financially vulnerable participants. Check cashing services charge between 2 and 5% of the face value of a check to convert it to cash, a fee that a bank account holder never pays. Prepaid debit cards carry monthly fees, reload fees, and ATM withdrawal fees that compound into significant annual costs. Payday lenders charge effective annual percentage rates that can exceed 300%. These products are disproportionately used by people who cannot qualify for or access traditional banking services. The structural feedback loop is self-reinforcing. High fees reduce the ability to accumulate savings. Low savings sustain exclusion from lower-cost products. Exclusion perpetuates high fees. The financial system does not distribute its costs equally. It concentrates them at the bottom of the income distribution. This isn't a failure of the system. It's a feature of it. The 13th secret sits in the gap between what banks spend on marketing and what they spend on financial education. The answer is not close. Major financial institutions collectively spend billions annually on credit products, brand building, and customer acquisition. Financial literacy initiatives, genuine ones, not the branded content designed to create trust, represent a fraction of that investment. And the reason is straightforward.
An informed customer is a less profitable customer. A person who understands how compound interest works on credit card debt is less likely to carry a balance. A person who understands the true cost of a mortgage over its full term negotiates more carefully. A person who understands the spread between deposit rates and lending rates moves money more intentionally. Complexity in financial products benefits the institution, not the customer. And clarity, when it exists, was not offered freely. It had to be found. The 14th secret is the one that holds all the others together. The modern banking system operates on trust, not on gold reserves, not on physical currency locked in vaults, not on any tangible commodity with intrinsic value, on the collective behavioral assumption that depositors will not simultaneously attempt to withdraw their funds. Because if they did, if a significant percentage of depositors at any major bank attempted to access their money within a short time frame, the institution would not have it. The money has been lent out, invested, deployed. This is not a bug that regulation has failed to fix. It's the operational structure of fractional reserve banking. It has worked continuously because the assumption holds. Depositors do not, under normal conditions, panic simultaneously. Banks understand this, and so they invest heavily in marble lobbies, in conservative branding, in stable institutional imagery, in language designed to communicate permanence and solidity. The most powerful financial institution in your daily life is held together by your willingness to keep believing in it. That belief in the aggregate is the reserve. None of this means the banking system is about to collapse. None of this means you should distrust every financial institution you interact with. What it means is simpler than that. The system was not designed with your financial freedom as the primary objective. It was designed with the institution's profitability as the primary objective. And those two things are not always in conflict, but they are not the same thing. So what do you do with this? Not anxiety, not outrage. Clarity produces a different response than either of those. If you are earlier in your financial journey, carrying high-interest debt, building the foundations of a saving structure, the first move is accurate cost accounting. Understand the true price of every financial product you hold before you hold it. Strip away the marketing language and look at the spread, the fee schedule, the amortization structure. High-interest debt elimination delivers a guaranteed return equal to whatever interest rate you're paying. Nothing passive does that reliably. If you are in a building phase, income growing, beginning to accumulate capital, making decisions about how to deploy it, the central question shifts. The question is not how to save more, it is how to understand the difference between financial instruments that build optionality and financial instruments that erode it. Debt that funds appreciating assets is leverage. Debt that funds consumption is a liability. These are not moral categories, they are structural ones. If you are further along, assets accumulating, income diversified, beginning to think about longer-term structural decisions, the relevant shift is from being a consumer of financial products to understanding how those products function at scale. The tools available at the upper end of wealth are not magic, they are accessible structures, applied with better information and larger balance sheets. The rules were written by people who profit when you follow them. You have